Welcome back to Generations, the podcast that explores the heart, the strategies, and the legacy of family wealth. I'm Peter Leggett, the Chairman and Private Client Advisor here at Arrow Private Wealth. Today's episode's a really important one, and it's really entitled Trusts, Tax and the Transition, and this is affecting so many families right across Australia. It is without doubt the ATO have increased their emphasis and focus on this area, and we've seen that recently in the government economic forum that they put together. And to unpack this, I'm joined by my good friend and a specialist in this particular area, Robert Scheiber, founder and partner at Scheiber Partners. Welcome to you, Robert.
Brilliant, Peter. Pleasure to be here. Good to see you.
Now, Robert, let's set the groundwork. No question, the ATO have trusts and taxation in their focus, and we're hearing and reading about it all the time. How and why should families and business owners be concerned about this?
Well, being concerned is one thing, being aware is the other. I think they need to be aware that the ATO's scrutiny is tightening up on family trusts, and in particular one section, Section 100A.
So Section 100A, I've heard that spoken about many times. I suspect many of our listeners who are running structures and companies have heard their accountant talk about it. What's the essence of this particular section of the Tax Act, Robert?
At its most simple, it is a trust that earns money, and if it decides to distribute to a beneficiary, that beneficiary must get that money.
So in essence, this isn't just about tax efficiency anymore. It's actually about fair and clear disclosure, and it's ensuring that what was originally set up actually takes place.
Indeed. It's about compliance, it is about what's fair, and it's about taxpayers meeting their tax obligations.
So these changes have certainly, therefore, implications for family succession planning, and certainly for many business owners who are thinking about either selling, either internally through business succession, internally or externally. Would that be the case?
For certain. It's very important to ensure that your trust is fit for purpose, that you understand your trust deed, that you know what the implications are of distributing to beneficiaries, and that the beneficiaries understand what they're entitled to, so everybody is on the same page.
So, Robert, let's get practical. Let's get down a bit dirty here. So how does these changes, the emphasis and focus of the ATO, how does it affecting families and their thinking around this intergenerational wealth?
Yeah. So Section 100A has been around since 1978. So everybody and their advisors should be aware of it. But their focus is making sure that the intent of the law is being applied. And so for families, they need to make sure the documentation is right, that if they decide to distribute from a trust a certain amount of money to a beneficiary, that beneficiary, within a certain amount of time, have two things happen, that they have that distribution paid to them, or alternatively, have things paid on their behalf, and the money doesn't go somewhere else. And that's typically where the problem is.
There'll be many people who are watching this right at the moment and they say, Robert, I hear what you say, but I have no idea how that applies in my situation. I just leave that to my accountant. You're an accountant. You've been a private client advisor to some of the most, well, I won't say important, but many complex families here. What's your response when you hear people say, well, I just leave that to my accountant?
It makes sense. You should trust your accountant, should trust all your advisors.
Well, we expect you to say that.
Indeed, but you should ask the question. You should be very clear, now that this is a very topical issue, to be clear on what the law is required of you, because ultimately the client bears the responsibility. Yeah. And that is, if a trust decides to distribute money to a beneficiary and doesn't, then the tax consequences are severe and ugly.
So ultimately, responsibility does rest with the person receiving the funds. They're responsible for that.
They are.
And the person in whatever role it is who is distributing.
Yes, so the trustee of all trusts has that important obligation to make sure that the beneficiary is entitled to the distribution, gets paid that distribution.
Now, there's lots of people listening to this and thinking, my goodness, I don't want to be sitting here listening to sections of the Tax Act. I leave that to my account. Let's talk footy, let's talk cricket, let's talk, a nice glass of wine. But there are many people who run their business through trust structures. How does that apply? Any different to them?
Sure. So the way to compare this would be to someone who decides to run their business through a company. And that's a bit easier. The company earns money, makes profit, pays tax at the company tax rate. Trusts in their own right don't pay tax. They distribute to beneficiaries. But they don't want to pay perhaps tax at the individual beneficiary tax rate, which is as high as 47. They may choose to distribute to a corporate beneficiary, a company, or some might say a bucket company, the least preferred term, but a term nevertheless that gets bandied around.
Now, Robert, I've heard a number of accountants, not you, use that term. Every time I hear it, it doesn't sit well with me, a bucket company. What's the ATO thinking when they hear or see an accountant or advisor talking in that sort of language?
Although it may not be the case, but it does create the impression it's there for a tax advantage. So we prefer not to use it. We should use the appropriate term, a corporate beneficiary. That is a company who receives an entitlement like any other beneficiary. It just happens to be a company. And then you have to deal with a whole set of new rules regarding how to deal with distributions to companies. And that brings in a phrase that most people who have tax advisors would know, Division 7A. And that's a very exciting topic all by itself.
We're not doing Division 7A today, and all of a sudden people are reaching for the extra glass of whiskey to say, what the heck is Division 7A? I've heard about it. No. But broadly, folks, you don't want to be in Division 7A territory because it's not good news. Robert, let's move on to wealth management and that whole area around encouraging families to be reviewing this situation. There's probably a couple of points here. One is time to review their structures. Are they operating, are their objectives and aspirations appropriate for the family vision and values? And the second point of that is, are trust structures even appropriate anymore, for example? And then clearly reviewing their estate documentation, powers of attorney, wills. And can I throw in there, I know I'm raising a couple of points here, a topic that virtually nobody ever pays attention to, appointors. Can you unpack some of those points that might be appropriate for our viewers to pay attention to?
Indeed. So every year we all get motivated by tax time, June 30. I would never wait to tax time to have conversations about the things that you raise. You should start earlier. Everyone should put their mind around 3 or 4 months out from end of financial year. Start around March and April to think about what's important to your business and how it's run and the structures that are in place. That might involve reviewing your trust deed, talking to your advisor to make sure it is fit for purpose, about the resolutions you need to draft regarding the distribution of income, making sure that your appointer, the words they use, the ultimate controller of a trust, is the person or persons you want to be controlling your trust, because ultimately that role is all-powerful. And so as you get older, as you may need greater support around you from your advisors, you may think, is it me that should be the sole appointer? Should I have a joint appointer? Should I appoint a company with directors to be my appointer to ensure that my trust and the way that it's run is meeting its objectives?
Yep, understood. Recently, we got exposed to a family, and I won't go through in the broad details, but they had an existing discretionary trust that had been in place for over 45 years. And when we had a conversation with them, what came out of that was the assets that sit inside this trust were primarily now for the use of their grandchildren and generations beyond that. But the trust had already been in place for over 45 years. We're in the state of Victoria. Now, it's not, Robert, we're not going to the state, we're not talking football, we're not talking politics today. But what's your advice for a trust that's been around for such a long period of time? Because in the state of Victoria, there is a defined end time period for a trust. Is that not so?
It's a great question. Trusts gained popularity in the early 80s, and trusts have a life of 80 years.
Here in this state.
Here in this state.
Victoria.
Traditionally, they do in Australia for 80 years. So you do the maths, by 2040 and beyond, they'll start to run out of life. And what we need is to have some government concession or intervention on a state basis that allows certain trusts to last longer than that 80-year period. If that's not possible, then there needs to be some form of proactive planning on behalf of the client and the key advisors, lawyers, both planners and accountants, to do something about the assets within those trusts. Because once 80 years is up, those trusts need to find a new home. Otherwise, there's a significant tax problem.
It's an excellent point. And I know we're deep diving into this, folks, on a topic that many of you might be rolling your eyes on. And as I said before, well, that's my lawyer's responsibility, or I trust my accountant to get all that right. And that is the case. You do trust your professional advisors in getting that right. Robert, what should families in this intergenerational wealth, or business owners who run through trust, what should they be starting to think about and talk about and do now in respect of this topic that you've just raised?
Well, you touched on it before, Peter. The first thing they should do after listening to this is to go to the cabinet and pour themselves either a large whiskey or a glass of wine.
Exactly.
And sit back and think, what is it that has sparked their interest?
Yep.
And there are many things, but don't get too anxious about it. Knowing will relieve all anxiety. So reach out to your advisor and ask some key questions about what are the things that I need to be aware of that affect my trust, regarding distributions, payments to beneficiaries, distributions to companies and payments to companies, the life of my deed, the assets within my trust, and sit down for whatever time is required and explore it and see what pops out. Yep. And I'm certain that every client who has a trust, every business that operates through a trust will have something to think about and something to do.
Yep. We often refer to just picking up on what you've just said there, which is, to me, very valuable. And we've certainly done that on behalf of our clients and our professional advice. Anyway, we talk about doing a health check, getting a financial health check on your structures. That also applies to your estate planning. Now, I know you're not an estate planning lawyer, but you work very deeply on behalf of your family clients in this area. What are some of the key points around estate documentation that should be considered? And then what are some of your experiences of what's worked and what hasn't worked?
We all think we are going to live forever. And that means that you don't have to worry about who needs to look after you at certain times. Yep. And some of that obviously will come about through mental incapacity. And you don't know when that's going to come. It just comes. And you don't know you haven't got the ability. So be prepared. Invite people to work with you that can support you. Family members, trusted advisors. And have those persons be your appointer to stand in your shoes to make decisions for you when you are unable. So having a power of attorney, for example, to deal with business affairs, commercial affairs, personal affairs, a medical power of attorney to deal with your medical type issues. The lawyer will be well advised to take you through all of those supports that you can have in place to ensure that you're looked after when you're unable to look after yourself.
I think I hear a couple of key points that you're raising to us and to our viewers here is be clear about your vision, understand your family and your business values, the things that are important, but what's that succession plan look like? And increasingly today, we're having conversations with families and business owners about moving assets, family assets, whilst people are still here, not waiting until they pass away, importantly with that. And so one of the takeaways is involving the next generation below in the conversation. Can you share with our viewers some of your experiences, good, bad, and otherwise, from some of the families you've dealt with, where lack of preparation or lack of conversation with the next generation has proved to be a problem?
Yes, I can. I would start with this. And as a takeaway, all viewers should consider this very next step as the starting point for great conversations with your family. Always difficult to talk about, I'm not here anymore, what's yours, what isn't, how do we divide assets? I'd be beginning by saying I'm drafting a will. I need to know how to share my personal estate amongst family members. And don't forget, some things you can't put in your will. You can't put a trust structure in your will, a company in your will. It's your own personal assets. But all these things start a conversation. So, Peter, to avoid the difficult conversations and complexity with family, I would start by saying, I want to be doing these things, take a proactive approach. I'm going to put a document together. How do you feel about it? I'm going to put these terms in. You're part of it, and start the process that way and get the lawyer to document that for you.
Increasingly, we're seeing conversations from our side on the private wealth side, and certainly from your point of view as a practicing accountant and business advisor. This issue now around the topic is generations, intergenerational wealth transfer. There's activity that's already starting to happen. These conversations are starting, and they are starting to move assets for the benefit of the generations to come. So it's moved from maybe one or two generations before, I know we're using the word generations a lot, where when mum or dad die or grandma and granddad die, we open up the will and this is what it is, to no, we're living longer, so we've got changing demographics, but we're also the extraordinary amount of wealth that this country has generated over the past 30 plus years now is starting to be distributed while people are still alive. Yeah. I imagine that's a conversation you're having all the time now.
Said a lot, and you're right, Peter. Things have changed over the generations. It used to be that you die and everyone discovers what was going to come to them at the very after the event.
Yep.
Now people are proactive. They want people to enjoy assets, whatever form that takes, and it may not be an asset in a physical sense. It just may be personal type things. There could be antiques. It could just be cash. Very many things, and to share that sooner at the appropriate time seems to be a trend and a welcome trend, I think, and allows families to really understand what life is about.
Yep.
Brings them closer together.
Yep. So in many ways, as we start to wrap this up, thank you for your sharing here, Robert. I'm hearing a couple of different messages. One is about take control and have the conversation, but also understand succession in the structures that many assets are owned in a wealth sense or in a business sense. So understand how you would want that to be, and then have the conversation with the family and start to make that happen as well. Yeah. Is there one key takeaway that you'd like to leave our viewers with as we start to wrap this up, Robert?
Yeah, just have confidence in yourself, right? The people who have interest in the things that we're talking about have already a degree of understanding, maybe sophistication, but they're aware. But they may not have the confidence to ask the questions, the deeper questions with their advisors. Now might be the time. Be encouraged to talk to your accountant, your lawyer, a key family member, maybe the person who you're thinking about, or is indeed the executor of your will, and say, how do we bring this together? How do we get control of this and be proactive?
Yep. Understood. Robert, some good words of advice for us. Thank you for sharing your experience. And I think the takeaway here for our viewers is who have heard this message is start the conversation now within your own family. Start the conversation with your professional advisor, your accountant and your lawyer, your private wealth advisor, and just start to get some guidance around all this part. This is another episode of Generations. Next episode, we are talking with an estate lawyer around the tips and traps about getting a will done. Maybe that's a time to have just a little glass of the wine or the whiskey on the side, but an important conversation nonetheless. This is episode 3 of Generations. Thank you for listening. We look forward to seeing you next time. Bye for now.